Hello and welcome to today's webinar, Trump, Labour and Your Wealth, How the Netwealth Approach Can Help. My name is Matt Conradi and I'm the Deputy CEO and Head of Advisory and Client Proposition at Netwealth. I'm joined today by Ian Barnes, who's our Chief Investment Officer. Thanks very much for joining. Just a couple of things of admin for you to bear in mind before we get started. You can ask questions and there's a panel on the side of your screen to do that. If you have any technical issues, please just start by refreshing your browser. That normally fixes those problems. In today's session, we're going to be thinking about the current market environment, all the different things that are going on in the world. There's a lot of noise out there right now. How we think about investing and the activities that we've been taking more recently to combat some of these things that are going on, how our financial planning approach works, and also then there'll be some time for some questions and answers as well at the end. Maybe to get ourselves started today, Ian, we could think about some of these bigger changes that are going on in the world. How are you thinking about the overall environment?
Thanks, Matt. Well, as you say, it's a very fast-moving environment at the moment. There seems to be a lot of different policy elements that are in flux around the world at the moment. A lot of the time, we seem to be coming back to the new US administration, and markets are trying to navigate their way through all of the different policy goals. Inevitably, we think there's going to be quite a lot of noise. It's not something you're going to be able to avoid for the next 4 years. But previously, we've spoken about the environment around the Trump presidency as characterized as the good, the bad, and the uncertain. So the good has been positive business sentiment, low tax rates, and a deregulation theme have been positive. The bad is the elements of protectionism, and there people often think of the tariff policies that get spoken about a lot. And uncertain is the broader financial market environment. So if the deficit that people worry about stays high, we could see that bring on a lot of pressure to markets as a whole.
Okay. So one of the challenges, I guess, as an investment manager is taking all of these things that are going on around the world, all of this noise, the big geopolitical elements and so on, and synthesizing that down into a market view. So how are you and the Netwealth team thinking about that market view now?
Yeah, well, the market backdrop has been pretty positive for risk assets is the starting point. And that's something we always try to remember, is that there's always going to be things to worry about, but we can isolate a few points. If we show the slide about unexciting global growth, you can see that the picture for growth is pretty modest. It's strong in some areas, but pretty anemic in other parts of the world. The chart on the right speaks to what we call the PMI surveys, and they tend to show a level of corporate confidence about the opportunity for growth. Really, you want to be above the 50 mark and an improving level. So in the top right-hand corner of that chart, and you can see that a lot of countries now are pretty much hovering around the 50 level, suggesting that growth isn't great. And even those countries where growth has been strong, so they're above 50, have sort of drifted towards the left-hand side, suggesting that the picture is slowing. So that's a little bit of a concern, but underlying it, there is some resilience there from the growth picture. We then move on to questions around the disinflationary trend. Now, we all know that there was this inflationary impulse over the past couple of years, and thankfully, rates have been coming down. It's important to note that prices are still high, so people are still feeling under a bit of pressure. But more broadly, people are a little bit concerned that the pace of change has slowed. So inflation is remaining a little bit stubborn. In the US, you can argue that's because of a strong economy. Elsewhere, and particularly thinking a little bit about the UK, we're not seeing the strength of the economy, but we've still got some stubborn aspects to inflation. So that's going to concern policymakers. Of course, as I mentioned before, a lot of the noise is around fiscal and trade policies. We know that the administration is using them as tools, and we're sort of seeing a weaving together of foreign policy, trade policy, as well as the fiscal aspects. And markets are trying to think about what there is real, true policy agendas, how much is posturing, and how much is negotiating. And markets historically have found that quite a difficult path to pick apart with any level of confidence. But again, we've got to come back to the last point, that corporate fundamentals are good. It's very easy to see areas of volatility, things to be concerned about, but at the moment, earnings growth, so profit margins are doing pretty well, particularly in the US, but we're excited to see that broadening out a little bit further. Corporate bond default rates are low, and fundamentally unemployment levels are reasonably measured as well, so you can take some confidence on that, and that's why markets tend to reward investors over time.
Okay. We'll talk a bit later on about how we help individuals think about what level of risk to take, how to think about investing in the context of their plans rather than all the market noise. But once they've selected a risk level for them to invest in, how do you think about the Netwealth process helping you to navigate some of those ups and downs and when to make changes?
So the process that we focus on every day is really designed in sympathy with the overall idea of Netwealth. So taking an efficient approach to managing market exposure in a diversified way. There are three components to it, and if we show the slide with Netwealth's investment approach on it, you can see that on the left-hand side, we focus on our strategic allocations. Those are really the sort of the anchor to portfolio positioning, that if you were to set your portfolio in place and leave it for the next 7-10 years, you'd be happy that those exposures are doing the job set out. Then we look to instrument selection, so how we populate each of these different areas, and there we typically use passive investment vehicles, so either tracker funds or exchange traded funds known as ETFs, to give us that efficient exposure, keep costs low. And then the more ongoing aspect is thinking about things on a more cyclical basis. So are there any risks that we can see out in the market that we think aren't priced? And that's an important part of it. And how we can maybe make that journey a little bit smoother for our clients to make sure that they stay invested and reap the benefits of being invested over time. Now, clearly there's an interaction of those different components. Yeah. And so we've been making some changes both at the strategic level and also on a more cyclical basis quite recently. So if we move to the next slide, you can see some of the changes that we've been making. Now, the important thing to mention is that at the high level, our broad asset class exposures have stayed pretty consistent, and that's what we think is the best approach for clients. But within different markets, we've made some adjustments. The first one is within bonds. Historically, we've had quite a few different, quite nuanced targeted exposures to bond markets, trying to take different extra risk premium that are available. So investing in corporate bonds, investing in bonds which protect against inflation, or even some which help us to benefit from a changing shape of bond yield curves. Right now, we think that a lot of the fears that people have had around the government bond market have largely been priced. So we've been dialing our exposure across from the more nuanced areas back into our core exposure for government bonds. We think that investors are being paid quite nicely for the different risks that are taken on there.
So just sticking with bonds for a moment, some clients say to me, bonds aren't very safe, I'm worried about inflation. How do you think about the role of bonds today in portfolios, and particularly for those more conservative clients?
Well, the good news is that inflationary impulse that caused volatility in the bond market has led them to reprice. So now, unlike many periods of time over the past 15 years, you're getting an excess yield above the level of expected inflation. Now, our expectation is that we do think that the disinflationary trends are in place, but we think that inflation will probably settle at a higher level than central bank targets. We typically target about 2%. We think it's going to stay over time slightly higher than that, but you're still getting an extra yield pickup, which is something that is quite new to markets and more akin to the times before the global financial crisis, when that was the norm. Yeah. So you've got that margin of safety already baked in. There are some other aspects coming from the fiscal policies, but I suspect we might talk about them in a bit.
Yeah, absolutely. And we'll also talk about in a moment perhaps some of the other asset classes that can help provide protection. But before we do that, when we're thinking about some of the recent changes you've made, and particularly back to that sort of process between the strategic and the cyclicals, what are the things you've been doing to reflect the new Trump government and perhaps some of the impacts that might have on our view on growth in equity markets?
So the The presidential cycle is an interesting one, as you know, a 4-year period falls sort of halfway between our more strategic long-term outlook and then our more sort of cyclical approach, because we have to accept that the administration is going to be involved and generating news for quite a period of time. The starting point for strategic allocations tends to be around valuations and the long-term outlook for earnings growth. And so there are areas that have been very successful at generating earnings growth, predominantly larger companies within the US. And then there are areas which are a bit cheaper, which is broadly the rest of the world. We've actually been reducing our exposure to the UK market, where our confidence in the ability to generate future earnings has decreased. So we don't think that some of the attractive valuations in the UK are going to be released in the near term. So we're reducing the UK and expanding our exposure to the US, but not to the largest companies, but also other parts of the world. So emerging markets, Japan, and to a lesser extent, European equities.
So you mentioned it increasing to the US, but not to the largest part of the market. And you also mentioned earlier on that we tend to use passive funds or tracking funds. I mean, one question I think we often get from clients is, well, doesn't that not mean you're overexposed to things sort of naively? But you're mentioning there that we can be a bit more targeted. And how do you think about that relative to maybe handing that over to an active fund manager?
Yeah, that's a great question. The difference is that the growth of the ETF market gives you a breadth of opportunity of ways that you can target different parts of the market. So in this instance, we've looked at the S&P 500 index, so the usual index that people think about for the US, but weighting the companies within it on an equal basis. So rather than overexposure to the largest companies that you might expect just in a plain vanilla strategy, we've got a slightly more nuanced one. And we've also taken some exposure to some medium-sized companies where we think the quality of their prospects is still pretty good, but you're just not looking at the more expensive valuations.
Okay. So whilst we still get the benefit of those lower cost tracking funds, we can be quite nuanced in the way we get those exposures through time.
Exactly. Yeah. We don't think that you need to pay up all the time to get the exposures that you want in the portfolios.
Okay. Now, one other area that we often get asked about in portfolios is perhaps those alternatives, the different areas. And in particular, when we're thinking about inflation and maybe geopolitical risks, I know gold's been something that's been talked about quite a lot. What's the role of alternatives in the mix?
So the role of alternatives for us is to provide more diversification. Now, what does that mean? Well, it means to be sure that we can have something in portfolios that is doing well when some of the larger components are coming under a bit of pressure. Now, that's not our base case at the moment, but you want to have something that is there to behave differently. What we don't do is invest in illiquid strategies. So all of our alternatives can still be bought and sold on a given day. Not that we're changing things day to day, but 100% of the portfolio can be realized at any point. The role of gold has been really important this past year, as it's been about the only asset that has managed to keep up with some of the best performing equity strategies. And that speaks to some of the concerns that people have around government bond markets, but also broader commodities have done well, particularly natural gas so far this year. And also we have some strategies called trend following funds, which are able to adapt their exposures quite flexibly to a changing market environment. And we think that will prove particularly useful if we see a point of stress, which you're likely to see as markets ebb and flow over time.
You talked about the fact that everything is liquid and daily accessible, but that we don't trade on a daily basis. Maybe you could just touch a little bit on what's the sort of normal cadence of trading. I mean, at the moment, there's so much news flow. We could be trying to react constantly to the latest tweet from Donald Trump. But how do you think about that in the portfolio?
Yeah, well, first and foremost, we're quite resistant to changing exposures on a day-to-day basis. It's particularly hard at the moment to try and think that you have a better handle on what is noise versus signal when interpreting policy changes. We typically try to fit all of our positioning changes, and we're talking about the more cyclical changes, within our monthly cycle. So our investment committee meets on a monthly basis. We're very happy if we come out of that investment committee meeting with the conclusion that we're actually happy with the way that the portfolios are set up. So quite often we won't make any changes. This month, just this week, we took the decision just to broaden out our exposure to the Chinese equity market, where you've seen quite a lot of volatility from domestic challenges as well as domestic policy intervention, but also because people think about China really being in the crosshairs of US trade policy as well.
Okay, so it's fair to say you have the ability to make changes, but actually you're not looking to try and react on a daily or weekly basis to the latest piece of news, and quite realistic about that.
Yeah, absolutely.
So we've talked quite a lot about the approach and some of the changes you've made. You mentioned reducing UK equities. If we turn now to the UK government, perhaps we've had a new government, we've had the first budget. This is a Labour government that is talking about driving growth. But how are we finding that impact it's having on the sort of view on the UK and on our outlook for this economy?
Yeah, I think that overall the business community has been a bit disappointed with some of the changes that the Labour government has introduced, just because of what the outlook for growth might look like. Now, a lot of people are concerned about the fiscal view for the UK. We know that that's been a topic that's been quite at the forefront of attention, not just for this government, but for previous ones as well. And the fiscal position, isn't that great. Our colleague Gerard Lyons was on the Institute for Fiscal Studies podcast recently, talking about fiscal headroom, or perhaps more appropriately, fiscal sustainability. And we think that the Chancellor is going to have a few challenges when the OBR, Office for Budget Responsibility, review comes up in the next month or so, in terms of how they can tweak future policy to stay within the tram lines that have sort of been set by third parties. And that's going to remain a key focus for markets as a whole.
And so one of the jobs that my team in the financial planning side do is try to take some of these changes that are happening and think about what it might mean for the individual plans. And we saw with the budget lots of changes that came around tax and taxation, and thinking about what that means for individuals. There was quite a lot of focus on corporates, and I'll touch a bit more on what it means for individuals first, but we did see those changes to national insurance. We saw that the impact that might have on minimum wages and so on. So is it fair to say that the corporate outlook in the UK is probably not as strong as somewhere like the US?
Well, I think the UK market has had a problem of earnings growth. That's partly a reflection of the type of companies that make up the index as a whole. So we like holding the UK still because it complements quite nicely the different sectors that you're exposed to within the US. So you've got high, strong quality growth in the US. In the UK, slightly more defensive characteristics. So high yielding stocks, more stable sectors, if you like, but the earnings delivery hasn't been there. And we think that it's hard to imagine that the catalyst from the direction of travel for the government is really going to be able to provoke stronger growth in that area. So that would be our concern. But as you say, perhaps for our client base, a lot of the more important challenges are going to come from the personal side of things. So I wondered if you'd like to talk about that.
Yeah, absolutely. And I think it's a really interesting challenge, because we get lots of questions from clients before every budget, before every statement. What's going to change? What should I do? And philosophically, when we think about financial planning, we really want to stay working with the rules that we faced at that time, keep the plan, update it if you need to make changes if things happen, but try not to second guess too much, because then you often find yourself running into trouble. We saw people worrying about tax-free cash on pensions and panicking and taking that tax-free cash out. We would never suggest you do that. React to the rules when they happen. Most of the time you get time to react. But if we think about the changes that have happened so far, There's been some pretty big impacts on IHT, and we'll touch on what that might mean in a bit more detail in a moment. But also, we have to look at the fiscal position for the UK government and think it's realistic that we're going to see more changes going forwards. So we saw they've backed themselves into a corner that they can't necessarily increase income taxes, for example, but they are probably going to do that in a stealth way. We've seen them freeze personal bans for income tax rates for tax-free cash. There's been talk about things around ISA allowances and so on. So there are ways that as an individual, this is going to have an impact. They're not fundamental to someone's financial planning necessarily, but they're nuanced and they do make a difference over time. And we need to keep that in mind. I think it probably highlights that even more as we come towards, for example, a tax year end now, the importance of doing all the sensible things all the time, bit by bit.
Mm-hmm. Do you think that so pensions are obviously a topic of great interest for our client base? Do you think that pensions are still going to remain a prime route for saving in the future?
I think so. For most people in the accumulation phase, a pension is still a great vehicle. It gives you tax relief on the way in. So if you're a higher rate or an additional rate taxpayer, you get that money in gross before that. You can still take up 25% tax-free to a level of just over £1 million. So it's worth building that up. That money rolls up over time. But it is going to be a little bit more nuanced now for those that are a little bit older, that are thinking about maybe having excess funds that they might want to pass on in the future, where in the past, pensions were outside of your estate for inheritance tax, but from April 2027, they're going to be inside your estate. So it's going to be more nuanced, and people might want to balance the flexibility of putting some money in ISAs, paying down debt as well, because that's the other big change that's happened. When I think about the environment in the UK, we've got a scenario where interest rates are expected to fall, but maybe if inflation's a little bit higher than expected, it won't fall as fast, and you need to consider the cost of debt as well. So it's nuanced, but for most people, if they're going to do some regular saving and they're in that accumulation phase, pensions are still a great vehicle, and we shouldn't sort of throw the baby out with the bathwater.
And in terms of the broader picture for inheritance tax rules, how are the team thinking about that, and what are you saying to clients?
This is where it starts to get a bit more nuanced. And in fact, I think we've got a slide called Passing on Wealth, which is something that was really important for us to be thinking about, because when you're thinking about inheritance tax, obviously you might want to mitigate tax as much as possible. And some clients literally don't want to pay any tax if they can there. And that is a difficult challenge. We have to think about the trade-offs between tax efficiency and control. Pensions used to be a great vehicle. Essentially, you could think of them as a sort of insurance policy. You could hold on to it. You could draw on it if you needed it. It was the last pot you touched, and then it could pass on efficiently to your children. Because from April that's going to change, we need to think about that quite differently now. We also need to think about how do we feel about gifting, and should we be doing it today? So one of the things we help clients think about is how much they could afford to gift. That's very different from how much they're ready to gift. And it's normally a journey that we go on with those clients over multiple years, thinking about doing it in tranches, because the most tax efficient thing you can do is just make a straight gift to a child, a grandchild, or so on, what's called a potentially exempt transfer. This is often what's termed the 7-year rule. If you make that gift, it's their money. If you wait 7 years, it's outside of their estate for inheritance tax. And so that's really tax efficient. At the other end of the spectrum, if you really want to keep control, you can use something like a discretionary trust. But they're very tax costly. There might be taxes on the way in, there's charges every 10 years, and you pay the highest rates of tax inside them. And so for most clients, they won't be the right thing to consider. It's normally a blend of these different things for them to think about through time. There's lots of structures. I think what doesn't show up on this chart as well, though, is that there's also an administrative element and complexity to it as well. And for most people, a good financial plan is a combination of tax efficient, helping them achieve their goals, but also keeping it simple. So we work with clients to work out where on this spectrum they want to be and how that might evolve through time. I think the other big change that came about around IHT was the changes to business property relief and agricultural property relief. We've seen obviously lots of news headlines around the impact on farmers and so on, and this will be impacting some people. Those changes come in from April 2026, and I think anyone that knows they were relying on business property relief or agricultural property relief should get in touch with an advisor and talk to them about it. I also think we have to understand the direction of travel that's going to come as well. So we talked about further changes. It's likely that there might be more changes around inheritance tax over time. Maybe it's reliefs, principal primary residence, those sorts of things that we just need to keep an eye on when thinking about what that impact could be.
Okay. And in terms of keeping an eye on all of these things, can you take a moment to talk about the Netwealth approach as a whole, how you're helping clients? on a day-to-day basis?
Absolutely. We've got a slide that comes up because what we try to do here is think about with the Netwealth approach, how you blend together those goals, those objectives that you're setting. So financial planning is a really key part of the way that we think about helping people. If you haven't established what your goals are and what you're trying to achieve, it's going to be very hard to know how you should invest. But some people do perhaps start the wrong way. They start with investment. I want to make money. I want to grow the pot. But it's much easier to pick the level of risk you want to understand when that's in the context of a wider plan. If you know that money is excess, for example, and it's for the next generation, you might take more risk with it. If you have the confidence from your financial planning, we do quite a lot of financial modeling, and there's lots of tools that we have online on our website as well. If you're confident that you have enough money for yourself, then you can be thinking about gifting. And then that's when it comes back to that idea of control or so on. But you can start to mitigate some of those concerns that you might have through time and keep things simple. So one of our focuses really when we're thinking about that financial planning, investment management overall, is keep it simple, keep it low cost, because that will help you get better net returns, irrespective of what's going on in the world. And in fact, we have a mantra that we think about, which is controlling the controllables. And what we need to acknowledge is there's quite a lot of things that you can't control for. These are the uncontrollable elements of investing or planning and so on. And that's things like what the average return will be over time. So I can't be certain what will happen in markets in any given period of time. And in fact, you shouldn't be worrying about it too much. You've perhaps got it wrong if you've got an investment that's in something that is very volatile and you need to worry about the short-term moves that happen. Because really what you want to be is never a forced seller. You want to be managing that out through time. You also can't control for inflation. We in a great way build portfolios that protect against inflation. And so if there is higher rates of inflation, we can feel confident that we should be able to mitigate that. But you need to understand it has an impact and erodes over time. And the other thing you can't control for is longevity. I'm always amazed at how much clients underestimate how long they might live. They often come to me and say, oh, well, I'm not going to live past 80. Well, if the average life expectancy in the UK is 86, and most of our clients perhaps might live longer than that, we would have thought. And when we think about joint lives, we always model to age 95. So there are things you can't control. Our approach really focuses on what you can control. And this is a really important thing to keep in mind. So the whole ethos of Netwealth is designed in sympathy to this, really. We're trying to say, don't try and time the markets. And you mentioned earlier, we're not day trading. We're not trying to react to all of those things. We're trying to accept that markets can give us returns over a period of time. And if we do sensible things, that makes a big difference. So don't time the market. It's time in the market. Be diversified. That's one of the great things that we can do. So it's really interesting for you to talk about gold and the role of fixed income and so on in portfolios, and particularly relevant for anyone that's thinking about drawdown, where that path of return becomes more relevant. So that diversification, accepting that you won't always pick all the winners, but being humble enough to understand that you need exposure to different areas makes a big difference through time. Then there are things that you can do that will have an impact whatever happens. And I think that's utilizing tax wrappers and planning is really important. So I mentioned that the government is sort of adding in stealth taxes in terms of not increasing allowances and so on. What you need to be doing is making sure you're not missing those opportunities as they come up. Are you using all of the different allowances and wrappers that you can use efficiently as possible? And then the other thing that we're quite passionate about is, can you minimize costs through time? Because that's the hurdle you have to beat to get better net returns every time. So we think about all of the areas where we should be paying fees, and it's right to pay fees for some things. So it's right to pay fees to get exposure to a market. It's right to pay fees for financial planning, but we want to keep those costs as low as possible. And that's really, it compounds up through time and has a massive impact for us. So we're really focused on controlling those controllables, making it transparent and understandable for clients so that we can get better net returns.
Yeah. Okay, that's which is ultimately the point of everything.
Absolutely,
is taking what the market can deliver to clients and passing on as much as possible to people in a way that they can see the benefits.
That's it.
So we had some questions come in where people were kind enough to give us some ones before we started, but a couple coming through during the presentation as well. I think if we can start off, we had one that's quite specific. So someone has said, I want to start passing wealth to my children, but I'm nervous of just passing them cash today. I already help them with school fees for the grandchildren, but that is a relatively small amount each year. Looking for some advice as where to start.
Okay. Well, first thing I'll say is we'll cover this in a fairly generic way, but if anyone has specific questions, do please send those into advice@netwealth.com because we'd be very happy to see where we can help. But if they're thinking about passing that wealth fund, it's back to that idea, and they've raised it really in their question about control versus tax efficiency. So they want to be more tax efficient, have less inheritance tax in the future, but they're worried about just handing money on. The nuance that I would pick up on there is the idea around the grandchildren and paying for the school fees. And there's something they can consider that blends quite nicely tax efficiency and control, which is called a bare trust. As a grandparent, if you give money directly to a grandchild, it's then taxed on that child in the future. And if they're under 18, then they won't have other sources of income and capital gains, so it can be quite tax efficient. You can remain as the trustee and have control over it and spend it for their benefit. So the benefit here versus just paying the school fees each year is you could put a chunk of capital into a bare trust today. You might gift £200,000 to cover school fees in the future. That becomes a potentially exempt transfer, starts that 7-year clock from today, rather than each year it passing out of your assets in the future. So that's the kind of nuance you could consider. You can do more complex things, like you could use your nil rate band, the 325, or for a couple 650 from IHT, and put it into something like a discretionary trust. But again, is that the right thing in terms of complexity or not? We like to think about those simple, sensible things like bare trust, which can be a really nice way to blend that.
Okay. Thank you. I've got another couple that are more sort of investment focused, so I might take those. Question is, do you apply stop losses on positions, and how do you decide when a low point has been reached and investment should be recommenced? Which is interesting. So it's again quite technical. It's sort of implying that if you're investing in a particular area, are you then going to, do you have a specific point, a market loss, say, where you just sort of say that's enough's enough, I'm going to step away from market exposure and then sit in cash or somewhere else and then reinvest? And our answer to that is fundamentally at the portfolio level, no. We are believers that you are investing for the long term. It's very difficult to anticipate exactly when the market is going to reward your investment and when it's going to punish you with a bit more volatility. And so getting in, or rather getting out and then back in to market exposure is particularly difficult. What we do, however, is have a very disciplined approach around our cyclical positions. So for instance, earlier this year, we had a hedge on our Japanese equity exposure, such that we didn't have the underlying currency exposure within our position. We hedged that back to US dollars because we thought that the extra yield you were going to receive would be more beneficial. That ended up being quite a volatile position, and we monitored it on a day-to-day basis to see how that was reflected in overall performance. And we had specific ranges in mind. In the end, the period of volatility we were able to navigate through by making incremental investments at different times and close that out in a couple of months ago. But we don't believe that just sort of saying volatility is too much, I'm going to stop investing through time, is the right approach to actually delivering that ongoing return.
Yeah, and I think that comes back to this point on financial planning. If you've matched up the subsection of your goal with the right level of risk, the volatility shouldn't matter too much. You shouldn't be a forced seller and an uncomfortable seller. And that's what the plan is designed to do. So there'll be elements of cash that won't be getting great returns. Perhaps in a moment you can touch on what you think expected returns might be for some of these different areas, but there'll be lower risk things that aren't more volatile, and that gives you the freedom to have volatility in other parts and perhaps not try to be too complex with things like stop losses, I guess.
Yeah. Okay.
Sticking with returns, though, I guess we did have a question about with the world going on, what are sort of your expectations for different market returns going forwards?
Yeah, so again, that's always a difficult one without a crystal ball. We do make assessments of what we think the likely range of returns are going to be over the long term for different asset classes, and it can be more predictable for some than others. So you can have an expectation of where interest rates will lie over the next 5-10 years. And that will drive outcomes on things like cash and will also influence government bonds. I spoke before about how our expectation is that interest rates will stay at a level to compensate for higher levels of inflation. So we think you are going to get positive returns after inflation on assets like government bonds, which is reassuring. It's a good starting point. For equity markets, you have to have an expectation that the range is going to be wider. But ultimately, we think it's something like 6.5 to 7.5% per annum over the next 10 years is likely to be acceptable. Perhaps what we can show, though, is the path of historic returns. So there's a chart with the main performance slide where we can see the path of returns over time for our different 7 risk levels. And in this case, they're the sterling risk levels. And the thing we like to remind clients is that the navy blue line showing the most volatility of a risk level 7 is also the portfolio that has made the best incremental returns over time. And there, the annualized return is up north of 8% over time, and that compounds up to decent levels.
Absolutely. And look, I think it's always interesting looking at this chart just to see how they've remained internally consistent. And that as a planner makes me feel more confident that I can say this is a low risk pot versus a higher risk one as well. How do they sort of compare on a relative basis though? And when we think about how we've done versus the peer group, we often look at ARC as an index.
Yeah, so we do show the comparison against our peers. And if we can show the experience over time, our performance in the navy blue bars here tends to be ahead of the ones that are in green, which is the peer group as a whole. Now, that doesn't tell the whole picture of just showing aggregated returns. What we can show is the incremental performance at different times. So if we move the slide onto the next one to show the performance over different periods, you can see that year to date, but also 1 year, 3 year, and 5 year, we're pretty pleased with the way that they stack up. So it's about 1 to 1.5% per annum ahead of our peer group. And it's important to understand that doing things efficiently and the way that Netwealth is built for scale at low cost gives a massive tailwind to that relative performance. We think that we can put together sensible investment portfolios, taking into account people's personal situations, and do it at a lower cost than has historically been the case. And that's where the advantage comes from.
Yeah, and I think that goes back to the overall approach of controlling the controllables. If you can keep that cost down, then you can compound that over time. And it's great to see the results actually showing that versus the peer group as well. We did have one more question that came in just now that I think it's probably one for me. It's a bit more technical. Main residence relief relabours recent changes to APR and BPR, so that's agricultural property relief and business property relief. Will the value of a farm or business less than 1 million still affect the additional residential property relief available? So this is quite technical and probably highlights why people need to talk to advisors about this. There's a few different reliefs and elements in there to be keeping in mind. The additional residential property relief is for estates that are below £2 million in total. And that's the key thing to look at. So before the agricultural property relief or business property relief kicks in, the £1 million that you can have before there's tax on those assets, we need to look at the overall value of the total estate. So if it's over 2 million, you start to lose that additional residential property relief at a rate of £1 for every £2 above. So that's the key figure here. If their overall estate's below 2 million, they'll keep the residential part. If it's over 2 million, including the farm business, for example, then they will start to lose that residential relief as well. So I think that just sort of highlights how this is technical, but it's also quite clear that the government has not fleshed out exactly how all of this stuff is going to work. If I take the pensions rules, for example, there's still a consultation ongoing. It is not clear how people might be able to do that. I know we had a question saying, would it be linked to the pensions dashboard? And it's not directly linked to the pensions dashboard, but the pensions dashboard, for anyone that doesn't know, it was this idea the government was going to pull together technology to allow everyone to see all the different pensions they've built up over time in one place. It's been a project that's gone on for years and years and years and overrun. It highlights how hard it is to get this data together. And so a great idea from the government saying we want to tax pensions actually how they're going to implement that is going to be difficult, and it's going to be hard to navigate it through. So it's one we'll be keeping a close eye on and see if that impacts on people's plans.
One other question I thought was important to ask was just in light of the approaching budget and all the fiscal changes that are going to be coming, what are the things that you and the team are going to be looking out for that you can sort of help clients get through in the coming months?
Yeah, it's a really good question. So I think it's just making sure you're going through and really being clear on your goals and your plans and the things that you want to prioritize, because then it becomes a lot easier to make some of those decisions about what you're trying to do. So you can't put off this planning. I think that's the main point. So if you want to think about inheritance tax, for example, it's a multi-step process, a multi-stage process, and don't defer it until you're 70 or 80. And I think it's just how you navigate through that makes a really big difference. In terms of specifics, I think it would just be make sure you're doing all the sensible things now. Going back to those controllables, if you miss those opportunities, then you're really going to have a challenge, because it's going to become difficult to achieve your goals as well through time. I think for now, that's pretty much all we've got time for. Thanks everyone for joining. If you do have more questions, please do send those through to advice@netwealth.com. If there was any questions we didn't manage to get to today, we will try and come back to you directly as well. So thanks very much for joining, and we look forward to speaking with you again in the future.